You keep losing trade because you don't really understand how the market moves. ICT call it market structure. Once you've understand this stuff, the chart will start to look so simple. So on today's video, which is episode 2 on ICT Simplified series, I am going to break market structure in a simple terms that you will understand step by step. So we are going to talk about all of these topics. Yeah, I'm going to define how to identify swing lows and swing highs. On the bullish trend, we have the higher highs and higher lows, which is HH, higher highs and higher lows. On the bearish, you have lower highs and lower lows, right? Break of structure, right? I am going to explain why ICT call all of these liquidity points, all the swing highs and swing lows, liquidity points. So as time goes on, you will understand what is market structure, because market structure is one of the basic stuff you need to understand. In forex, we have two or three types of trends. We have the uptrend, we have the downtrend, we have the sideway or consolidation, right? This is known as a consolidation because for a quite long time now, gold has been consolidating. So it's not giving us a particular trend. An uptrend is when price is moving in the up direction and it's going to like it's breaking highs and respecting the lows. While downtrend is breaking the lows or respecting the highs. Now, for every low, there is a high, and for every high, there is a low, right? So every low that breaks a old high is called a swing low. That's a swing point. I like to explain forex in a layman understanding so that people can understand forex in their own meaning. Do you understand what I mean? What I'm saying is, for every low, there is a high amount of buyers at that particular point. So that means there were not enough volume for sales. Market is all about like it's like war. People are buying, people are selling. But if there is a high volume of the high amount of buyers, then obviously it's going to break those people selling. For you to make profits, there must be a sell. Let me hide this stuff. This is a high and this is a low. So that means people were selling at this point here, down to this side, right? Now, people started buying. It got to this point, this previous high that people were selling. But what happened? They started selling back again. But there's enough volume for buys here. So what happened? They broke. They took out people selling here. That means people were holding stop loss above all this high here. So they took out what? Profitable sellers. So now we have profitable buyers now currently at this point. So when price takes out profitable sellers, we have a break of structure. Price keeps on taking out profitable sellers. We have another sell here, right? What happened again? There's a high volume for buyers, took them out, right? So if price keeps on taking out highs, respecting the low, we are in we are on an uptrend. We are on a bullish trend. Same goes for downtrend. Let me look for a downtrend, which is GXY. This is a downtrend. When price takes out the lows while respecting the highs. I mean, we have a set of buyers here, set of buyers here, but what happened? Price took them out for a break of structure. Another break of structure here, and so on and so forth. Like I said, we have a high and we have a low, right? If the high breaks the low, that's a break of structure. If this high, this is a break of structure here again, we have a low, we have a high. The high breaks the low, we have a break of structure. Now, remember, for every high that breaks a low, that's a swing point. That's a swing high. So if let me mark all the highs here now. This high broke this low, so we have this high here. This high broke this low, so we have this high here. This high broke this low. So we have this high here. So all these are swing points here. This high broke this low. So we have the high here. Right? Do you get? So this was the last break of structure. Mind you, we are working with time frame. This is a daily time frame. So on maybe on lower time frame, we might see another trend there. For every time frame, there's a trend on that particular time frame. So I'm using a daily time frame here. So like I said, this is the last swing high, the low, right? The beginning of the video, I said something of break of structure and change of character. Now this is a break of structure. This is a break of structure. Structure. This is a break of structure. For you to now say price have changed character, there's a change of character or market structure shift. It is when price now change from one particular trend to another. How will you know price has changed trend? Like I point out all these swing high. For you to know price have changed character is if price now comes back to this low, this high, sorry, breaks this high, come back and retest on maybe any zone here, then push onto the upside, then it is classified to be a change of character. Price might sweep this guy. People will say, okay, that's a change of character, but it might just be a liquidity sweep. Today, my focus is basically on market structure. We'll talk about liquidity on the upcoming videos. So, like I said, we have a swing high, we have a swing low, we have a swing high, we have a swing low, we have a swing high, we have a swing low, swing high, swing low. So, for price to now change character, if price takes out the previous high, still respect any demand zone that took out the previous high, then continue the trend, then that's a change of character. What I'm saying is, if price takes out this guy, then still come back here, then still goes back up again, then that's a change of character. Then keep going up. Remember, I said on the bullish trend, price is respecting the lows, taking out the highs, respecting the lows, taking out the highs. Same thing we did here. Same thing we did here. All these highs are respected. So those are swing highs. Then why the lows that have been taken out is called weak lows. So those are high liquidity points. Why is it liquidity points? Because people are holding their stop losses there. That's called liquidity. Liquidity is where people keep money. Where are people putting their stop losses? Where are people putting their market execution? They buy stop, they buy limits, or whatever. Because market is being foiled with money. The big banks, they need high liquidity. They need people to put money for them to take them out. So the swing high and the swing low. If a swing high takes a swing low, obviously we have a high volume for sellers. So that means the market currently is at the position of the sellers. If you are buying, you just leave it for them. They have more power than you. Except the swing low is now taking out the swing highs. Then you will now say, okay, now the buyers now is now in position. You will leave it for what? The buyers. You stop selling. That's how it works. Like I said again, a recap. We have bullish trend, we have bearish trend. A bullish trend is when market is taking out the swing highs, respecting the lows. Taking out highs, respecting the lows. So that means we have a strong low and a weak high for a bullish trend. A strong low and a weak high for a bullish trend. Taking out profitable sellers while maintaining their buy positions. Why the bearish trend taking out the lows while respecting the highs. Weak lows, we have a strong high. Stronger in the sense that there is high volume for sales and there is a weak amount of buyers at that market. So that means we have a strong sellers and weak buyers. So if you are in that position, you go with the sellers because like they say, the market is always your friend. So, but for consolidation, we do not know who is at the control of the market. The market is taking out both the buyers and the sellers. Today it's going up, it's going down. So it's taking out both the high string profitable buyers, profitable sellers. Like I said, gold is consolidating. Price is still taking out the profitable sellers, taking out profitable buyers, taking out profitable sellers. So it's both ways, which is just taking out both people participating in the market. How to identify a consolidation? You just draw a box, you see it doesn't move in this one direction. Like when you see an uptrend, you know this thing is going up. When you see a downtrend, see it's coming down. But this one is just going up, that like it's going sideways, right? So it's consolidating. I hope by now you've understand the basics of market structure. On the next video, I'm going to explain more details. I'm going to give you more example on how to identify market structure using higher highs and higher lows, right? So to make it more simple. On this video, I just basically use one time frame, which is daily time frame. But on the next video, I'm going to teach you how to identify market structure on each time frame. If there's a bullish trend on daily time frame, you can also get a bearish trend on lower time frames, maybe on 1 hour, 30 minutes, or 15 minutes. So stick around, like, share, subscribe, and continue to follow this series. Thank you for watching. See you on the next video. Stay safe, stay blessed.